Welcome back, folks. This is ICT with a fifth installment of the 8 in the continuing series for the first month of the ICT mentorship for the month of September. The previous tutorial in session 4, we looked at equilibrium versus discount. This session, we're going to be looking at equilibrium versus premium. We went through a great deal of content in regards to discount versus equilibrium, so we won't have to spend so much time with this tutorial because everything we're showing here is basically diametrically opposed to what you would expect to see in the equilibrium versus discount teaching. So looking at what we have, when we look for premium markets that are in a premium, now when we talk about commodities later on in this mentorship, the topic of premium will come up again. But when I'm referring to premium as it relates to price action, I'm actually referring to the current range that we're trading in. And the first thing we look for is an impulse price swing, which is we have an impulse price swing here, we have another impulse price swing here, we have another impulse price swing here. So the first thing we look for in price is an impulse swing. And we see one here, we see another one here, we see another one here, and these three price swings actually make up one larger price swing, which is an impulse leg or impulse swing by its own right. So when we define our ranges, okay, the use of the Fibonacci is helpful in this case because we can take the fib, draw from a high down to a price low. And I'm using this low here because it's the most lowest in contrast to this high. And price comes all the way back up to what I have taught in many years, the optimal trade entry, which is a standard 79% to 62% retracement level on the fib. Now, I didn't create that, but if it was just simply looking at that alone, 62% to 79% retracement levels, looking for buys and sells there, everywhere we loaded, it would be no work at all in terms of taking trades. But obviously, you probably learned very quickly, there's much more to it than just pulling a fib over top of price swings. We have in this larger price swing, we have a smaller price swing here, okay? And we have the high down to this low, and the market starts to retrace. Equilibrium, or half of the impulse price swing, has to be at least touched, and then once it hits that, we watch for price to reach up into this area here. Now, there's other disciplines out there, and other mentors and other teachers will say that the 50% retracement level is a good level to trade at based on price swings. I don't agree with that. I understand that sometimes it's going to work, but what I want to do is I want to be selling at a market that's at a premium level. For a market to be at a premium in this current price range here, and that's assuming none of the price action from this high down all the way to the right has not happened yet. So you'd be watching price in this initial range, and price did not get back up to the midway point, or 50% of the range that was created from the high to the low. That's all equilibrium is 50% on the fib. That's how I'm describing it.